It's the gift that keeps on giving. Today's Farage Fortune and Freedom newsletter is all about gold. And Nigel Farage's investment writing partner, Nick Hubble, talks about in the newsletter setting your own personal gold standard. It's as simple, apparently, as just buying some physical gold. But of course, it's not that simple. So in this video, why owning gold as part of your investment portfolio is a really bad idea. I'm Martin Bamford, a chartered financial planner at Informed Choice, and in today's video I want to talk about gold as an investment, specifically about why it's probably a bad idea for you to buy gold. And this is a video I'm recording in response to the latest Fortune and Freedom investment newsletter from Nigel Farage and his buddies. And I wanted to start, before I get into three of the really bad reasons for holding gold, by just debunking some of the statements made in today's newsletter. So just to go through just a few of those. So Nick Hubble, who is the writer of today's newsletter, says, over the last 20 years, it has outperformed the stock market comfortably. You don't hear a lot of financial professionals talk about this because, well, there's little fee to collect on it. So clearly Farage and Hubble believe that financial professionals like me, like my colleagues, are biased against gold because there's no fee to collect on it. And this was a similar argument that was made about investment trusts before the retail distribution review. Many commentators said that investment trusts were not widely recommended by financial advisors because they didn't pay commission. But of course now, and in fact since the end of 2012, we are in a commission-free world when it comes to financial advice, when it comes to all retail investments. And as a result of that, there is no bias towards any particular asset type. There's no commission to be paid on anything. So financial advisors are free to recommend the most suitable type of investment without that fee bias taking place. Hubble also talks about the fact that gold has outperformed the stock market comfortably over the past 20 years. And I really have to take issue with that one. He's picked a 20-year time frame. And if I look at the performance of gold versus the Dow Jones Industrial Average over the past 20 years, we see that gold is up 614% and the Dow Jones is up 161% during that time. But of course, that is picking and choosing a selective time period to prove your argument. What about if we looked back over the past 30 years? Well, over the 30-year period, gold is up 407%. Pretty good, pretty respectable. But the Dow Jones Industrial Average over the past 30 years is up by 1,074%, so 2.5 times the return you would have got from gold. However, these return figures, and where Hubble's referring to gold outperforming equities over the past 20 years, they miss something really important. And what they're missing is dividend reinvestment. Now, I'll come on in just a moment in the video to talk about the fact that gold is a non-income producing asset, and that's one of the good reasons not to hold it. But typically, as an investor, a significant part of your total return will come from dividends. Now, if you look over the past 20 years at gold versus the Dow Jones with dividends reinvested, then the Dow Jones returns 341%, so nearly 3 times as much as the capital return only. Gold stays at 614% because, as I said, there's no dividends to be paid. So gold still over 20 years outperformed the Dow Jones. But over 30 years, the return from the Dow Jones, including dividends, is not 1,074%, but 2,283% with those dividends being reinvested. So twice as much as a return because the dividends are coming back in. The gold return over 30 years stays at 407% because, as I mentioned, no dividends to reinvest. But please don't get hung up on these timescales. It's very easy when it comes to different investment asset classes to pick and choose a timescale that suits your argument. In this case, 20 years clearly suits the argument for Nick Hubble because gold has done very well over the past 20 years, but pick a different timescale. In fact, you should pick a variety of timescales to understand how that asset class has performed during that time. Something else Hubble says in today's newsletter is while the value of your assets might go up, down, or both over time, the gold you own probably won't be doing anything particularly exciting. And I guess this depends on your definition of particularly exciting, because gold is an incredibly volatile asset class. the price of gold really does go up and down quite significantly. So volatility in the price of gold is an issue. And when gold loses value, it can stay depressed for quite a long time. There was a peak in the gold price in 1980, but after that, the gold price fell by about 60% and remained in the doldrums for about 20 years. So when gold does lose value, it has been known historically to keep that value loss for quite significant and extended periods of time. Hubble then goes on in the newsletter to list a number of scenarios where gold is likely to do well, so a banking crisis, hyperinflation, that sort of thing. And yes, theoretically gold can do well in those scenarios, but there's no guarantee of this. This is speculation. And of course, it's almost hoping for a disaster scenario to occur to justify the value of your investment. And then remarkably, he refers to a 500-year track record for gold. And I don't know about you, but my investment portfolio is not set up to run for 500 years. I know there have been some advances in longevity in recent decades, but nothing near that good. And of course, the world today and the global economy today looks very different to the one 500 years ago, 200 years ago, 100 years ago. In fact, the world has changed a great deal in just the past 6 to 9 months, let alone the past 500 years. So it's not really a fair comparison, a fair argument to look back over 500 years of gold performance. Hubble concludes by saying, as I see it, gold is like insurance against monetary megalomaniacs at the Bank of England and Exchequer. Its purpose is to help you sleep at night, even when your other investments are bouncing around all over the place, and to protect you from the long-term debasement of the pound, better known as inflation. Now again, this is what Farage and co like to do best, pitching the people against the institutions, in this case the Bank of England. Monetary megalomaniacs. That's a fantastic term, isn't it? It really rolls off the tongue. But what does it mean? I think you really have to question this approach, which is trying to pitch one group against another all the time. It's very divisive, and should you really use that as the basis for your investment decisions? I'd argue you probably shouldn't do. And we've already mentioned the volatility of the gold price. So when he talks about it helping you to sleep well at night, well, yeah, you can sleep well at night if you can handle that price volatility. And also if you're not worried about a burglar breaking into your safe and stealing all of your wealth. And in terms of protecting you from inflation, what he talks about is the debasement of the pound. Well, gold is really a store of wealth over the very long term, but it won't add any value over and above inflation. So it may maintain its price and value, but over the long term, you only get value over and above inflation by investing in real assets like equities. So I promised you 3 good reasons why gold is a bad investment for most investors. And number 1, I've touched on already, it doesn't pay dividends. So gold is a non-income producing asset. And as such, it's a speculative asset. It's not really an investment, it's a speculation. You can, of course, invest indirectly in gold by buying mining stocks, and mining stocks do have the potential to pay dividends, but there's a very good chance that you already have some exposure to mining stocks within your traditional equity portfolio. And then there's the issue that gold has no utility really, and it has some industrial application, but the majority of gold production is used for producing jewellery. About 78% of gold production goes towards making watches and rings and necklaces and things. So it has no real utility value, a bit like Bitcoin. So on that basis, people do speculate on its value and they don't really invest in it. It is a speculation asset. Gold, while nice to look at, is pretty useless. And the third reason why I think it's a bad idea to invest in gold is gold will make you scared. Gold bugs, those who really promote gold as an investment, they peddle fear. And we've seen this today in Nigel Farage's newsletter. It's all about pitching one group against another. If you enjoy sleepless nights, if you enjoy believing the world is going to come to an end, then gold is your thing. But don't we have enough fear and worry in the daily news already? So if you're thinking about gold as part of your portfolio simply to hedge against an end of the world type scenario, you really have to question how you hold that gold. Probably the only real value in gold, if there is a collapse in the global monetary system, is going to be owning physical gold, because if you own it electronically via exchange traded commodities or funds, how are you going to get your hands on it when all the banks go bust? So let's say you hold it physically, you probably want to own gold coins rather than gold bars, because they're going to be much easier to exchange and trade should the world end. And actually probably you want to own something more practical, so silver coins might be more practical than gold coins. When you want to exchange them for a side of a cow or use them as a bribe to get past a militant roadblock. That's the scenario we're thinking about here. Gold owned electronically is not very good should the world come to an end. You want to own it physically. And if you're planning your future and your life like that, how worried, how anxious, how nervous are you going to be at all times about what's going on in the world? Gold makes people scared. So 3 reasons there to avoid gold as part of your investment portfolio. Do comment down below. Let me know what you think. I'm looking forward to hearing some of the comments on this one. And do subscribe to this channel for more videos like this, and leave this video a like if you enjoyed the content. Until next time, I'm Martin Bamford from Informed Choice. When it comes to your money, the more you know, the faster it can grow. Thank you for watching.